Well, hello, everyone. Welcome to your Daily 5. I'm Joe Duarte from Duarte and the MoneyOptions.com, author of the best-selling Options Trading for Dummies and Everything Investing in Your 20s and 30s. Options Trading for Dummies in its 4th edition, just out September 28th, now available everywhere. Remember, if you like what you hear here in this presentation, consider a free trial to Joe Duarte and the MoneyOptions.com. All right, let's get started. As always, we are at the edge of chaos. And right now, we want to talk about preparing for bullish surprises in scary markets. And today, let's review a little bit about bull markets. Now, we are in a particularly interesting market of late, so it's important to contrast where we've been and where we might go. So bull markets, of course, are about momentum. Up, keep up with the trend. You never want to fight the Fed, although I'm going to give you some information here in the next couple of minutes that will quantify that or qualify that a little bit. Again, never fight the momentum of the markets and look around and see what's happening and how you can make it work for yourself. You always stick with strength. You want to take those partial profits when you make 20%. Of course, never turn winners into losers. And here's something interesting. In a bull market, you want to give those stocks room to move. So you want those sell stops around 8%. Of course, always monitor the lagging sectors to see if something's about to turn around and manage that cash wisely. Now, we've been in a fairly uncertain market until recently, or the last several months. And of course, that becomes a risk management market because there's volatility. And when there's volatility, there's upside or downside risk. And so the key is to expect the unexpected and trade what you see. So currently, we don't want to fight the Fed, because they're telling you that they're going to taper, and that means that they're going to remove liquidity from the system, and so there might be some trouble for stocks. That's the mainstream view, but then you want to watch the market's response, and I'm going to show you that obviously that has not been the case so far. Again, here we go. Don't fight the momentum, but always be prepared for volatility. And in a scary market, until things become clear, you want to focus on capital preservation. But you always want to be ready to deploy that cash when it's time. Again, broaden your sector horizons. I'll show you a couple of things about that in a second. And here's a key thing. In a scary market or a volatile market or a sideways market where there's questions, you trade in those small lots. And the reason for that is because if you're always trading in 500, 800 share lots, when volatility hits, you can get whacked really hard. So you want to trade in smaller lots and shorten the time frames. I'll show you that in a second. Never let that winner turn into a loser. Keep those sell stops at 3 to 5%. You always want to survive to fight another day. So when markets get shaky, you want to change your game. You want to expect those surprises, manage that risk. And of course, again, upside risk. You don't want to miss anything if you can afford to do so. And downside risk, you want to protect yourself. And in that case, if you have a volatile stock that goes up, take that profit. And again, trade what you see. And here's the key to that. You want to compare the market action to the news. What's the market doing when news hits? So by broadening your horizons, comparing your market action to the news, we'll look at 3 stocks today. Builders Choice and Ryder Systems, and an interesting IPO called APP or Applovin. And I'll tell you about it in a second here. All right. First thing you want to do is where the market's going. Quick look here. Advanced decline line is making new highs. Market is just broken out from multi-month trading range. That means that the odds now are that stocks are going to go higher for the foreseeable future until we see a reversal in the advanced decline line. We are in the complexity zone. We've just broken out of a little mini edge of chaos because the market's been consolidating. Okay, so that's where the market's likely to go. Let's look at the news here. And of course, the market's response is what happens. Over the last several months, what we've heard about is nothing more but the Fed tapered. Market's going to go down, things are going to get bad. Advanced decline line's been going sideways. Stock market, S&P 500 has been going down. NASDAQ 100 has been going down until recently when it started going up. The news kept telling you that the Fed taper was going to be bad. But then when the Fed told us that they're going to taper and that they're going to be careful about it and so on and so on, market broke out. So it's the market's response that matters, not the news. Here's another example. Okay. For the last several months, we have been told that higher interest rates are going to kill the housing market. Well, here's Builders First Choice. It's the company that provides materials to builders. Okay, over the last several months, as the market has been grinding up and down, the stock's been forming a base. Finally, it formed a really tight trading pattern. Guess what? It broke out on earnings because they beat expectations well beyond anything that anyone had expected. I owned this stock until yesterday. We owned it in Joe Duarte and the moneyoptions.com. We went ahead and took our profits following those trading rules. The stock popped. We took some money out. Again, here's the key. When the news is bad, the short sellers come in, accumulation distribution goes down. That's telling you short sellers are in. But you want to see an unbalanced volume, because what happens is that this here is the smart money coming in to buy where the short sellers are selling. And what happens is you get this tight trading pattern. And as a result, the stock was poised for a breakout. So accumulation distribution, unbalanced volume. And here we go. Rate of change going sideways. Right now, RSI down here kept going to 50, but not breaking below it. That means that smart money is using every dip to come on in. All right. And again, you compare to the S&P 500. And in this case, the stock was actually outperforming the S&P 500. Comparing the price action to the news. Now, here's another tip for weird markets. All right. You become a story stock stalker. You start stalking the stock. And of course, that's kind of a pun, but whatever. Ryder Systems is a trucking company. They're in the supply chain. We hear the supply chain is going to be clogged up for a long time. And guess what? Ryder continues to go up a little bit at a time. We've owned this stock at Joe Duarte and the moneyoptions.com. I still have a couple of shares myself, not very much. The reason for that is I'm not really sure what this stock is going to do. Okay, but because of the news, because the stock is in a little bit of an accumulating pattern, I've had a few shares. I am stalking the stock. I'm waiting for this stock to tell me what to do. Okay, so when this comes along, what you might want to do is buy a few shares, see what happens. You can also sell a call and get some income while you wait. But the key is to compare what the market is telling you compared to what the news is. The news about the supply chain is that everything is horrible. Ryder's telling you, we're not sure about that. So buy a few shares, see what happens. Final stock is the IPO market. While all these bad news has been going on, while the advanced decline lines are moving sideways, we've had a lot of IPOs that have actually done very, very well. One of them is Applovin. This is an interesting company in which I own shares, and we own shares in Joe Duarte and the moneyoptions.com. What these guys do is they have a gaming app in which they sell ads, but they gather the data, put it in a software system, and sell the data to advertisers so they are better at targeting these people. Here's a perfect example. Again, accumulation distribution, short sellers coming in and smart money buying on the dips. Stock looks like it could break out. Have owned this stock for a while, and at this point, I'm just waiting for things to break out or break down before taking profits. Again, look where you normally would not look. I usually would not look at IPOs. Some of these charts are very compelling. So to recap, when the markets get shaky, you got to change your game. You go from momentum to risk management. You look for upside risk. You don't want to miss anything. So you look at other places where you normally wouldn't look, for stocks and for ideas. Downside risk, protect yourself by taking those profits earlier than normal. Trade what you see, compare that market action to the news, broaden your horizons, like the 3 stocks I discussed today, stock them, look and see what's going on, and act accordingly. That's all I have for today. I'm Joe Duarte from Joe Duarte and the moneyoptions.com. Look for my book on Amazon.com, the StockCharts.com bookstore. 4th edition, Options Trading for Dummy, everything investing in your 20s and 30s. If you like what you saw today, by all means, get a free trial to Joe Duarte and the moneyoptions.com. And always remember, trading is uncertain. Be prepared. I'm Joe Duarte. We'll talk again.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.